Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial opinions, and make your own financial decisions. Today is Wednesday, November 30th, 2022, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, who was not with us last week and didn't hear the 1% challenge firsthand. So in this week's episode, I'm going to talk to Viper a little bit about that 1% challenge. We're going to give some general commentary on the market because there was some pretty big news today from commentary of Jerome Powell as far as the Federal Reserve and interest rate goes. So we'll touch on that for a little bit. And we have our very first 1% play that I'm going to bring you this week. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can click on that link, join our Discord for free, say hello to Viper, myself, a few of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. We'll make it. You can also pick up this show wherever you get your favorite podcasts. And if it's not there, let us know and we will get it there. Lastly, thetagang.com/sprocket888, where I post each and every one of my equities trades, the good, the bad, and the ugly. But let's hop to this week's content, Viper. Viper, before we hop into stuff that I talked about last week, Jerome Powell coming through with some relatively dovish commentary on interest rates and where they are and rate hikes, and the market just grabbed hold of that thing. And I think the S&P swung almost 100 points, maybe over 100 points. It was a heck of a day. I went to lunch and I looked at my portfolio at lunch, kind of checking in, and I'm like, yeah, just kind of going nowhere. We've been kind of consolidating around this level, 3950 to 4,000. Then at the end of the day, I pulled out my phone and I said, holy guacamole, what did Jerome Powell say? I think S&P was up like 3% at that point. It was rocket ship, zip, bang, boom to the moon today.
Yeah, absolutely. And I mean, just for emphasis, if you want real quick, you can flip over to my screen here just to show, because I was watching the same thing kind of in the background where, you know, like you said, I mean, it was flat as flat today. And this is the 15-minute chart. And then I totally phased out, and I didn't even know I didn't even know he was talking today. I forgot. And then I caught some messages in the Discord, and I was like, whoa, wait, let me check. And then, yeah, sure enough, boom, like everybody liked what he said. And so, but I mean, it was, I feel like it was best summarized as realistic. And like, to me, I breathed a sigh of relief of just like, it felt like there wasn't this constant downward pressure. By all means, we could retrace, we could keep going down, but it just finally felt like there is hope. Like, I mean, after three rate hikes of 75 basis points, that it's just felt like constant, just smash it down. So, but yeah, he basically was saying we're still in a rough place. We still have crazy high inflation, too high of inflation, but things are working. And, you know, to an extent, I don't think he actually used the words saying that he likes where we're at, but, you know, he definitely indicated that, you know, we're finally at a point where maybe we can start pulling back on the rate increases, and then kind of hinted at when we pull back, we're just going to hold there for a while. And that makes sense. You know, the market likes not continuing to raise those rates. So I think it was a good day.
Yeah, I'm in the camp of maybe taking a break here because a lot of that stuff takes a little bit of while to work through the system. And the aggressiveness that we've hit the rate hikes is pretty hard and fast. And, you know, we don't have a lot of data points in the past where we've done that. And I feel hey, just wait a minute. Let's see how that goes, because you're starting to get inklings of, I mean, layoffs. You start reading more and more about them. Earlier this week, the euro inflation rate came in lower than the previous month. First time that thing's dropped down. I mean, it was still 10%, but last month it had grown by 10.6% year over year. So it was nice to see that break a little bit. And hopefully we're getting to a point where we can start assessing what's going on.
Yeah. And I think the last thing, because I don't want to say too much on it because I am grossly out of my element, out of my lane, but I am learning about it. And so that's part of why I want to bring it up is the long lead time of what to expect next. I mean, obviously this is our first time through anything like this. Not pulling back, but flattening out the rate amount is important. But I'm also learning a lot more about what to expect next, and there's no moon rockets coming anytime soon. Nothing like that, and that the reality is that next year could still be tough. Because going into easing, you don't just like put the pedal down as hard as they did and then go straight into easing those rates. It sounds like from what I've been reading and trying to learn, there's a lot of metrics that act like there's a lot of pain. It sounds weird. There's a lot of pain that needs to be had before easing can actually come into play. And so that was also generally studying up and reading about those mechanics was like, well, I mean, it's good news, but also, it's a process, I guess is what I'm concluding.
No, for sure. And actually that'll kind of bring us to our 1% play that I'm going to lay out this week, because there is a little bit of risk in this 1% play from that macroeconomic picture. And that pain is usually, at least historically, going to be a contraction in consumer spending. So once inflation starts to settle in, layoffs start to come, jobs start to contract, the consumer then starts picking up, hey, maybe I better start watching a little bit more. Credit comes in. Credit is not as loose. So that starts coming in, which prevents more buying on credit and things like that. Anyway, that type of pullback is what I think has been being priced into a lot of these stocks, is that forecasted time coming of consumer contraction. And so that's why I think you've seen a lot of retail and consumer-centric, consumer discretionary spending really take a hit here. That's also why I think you see tech take a hit, because tech is highly leveraged on funds and raising money and borrowing money to do dramatic growth. And so the 1% play this week is actually going to be KSS, which is Kohl's, which is a retailer. And so, that's definitely something that can play into that contraction of the consumer spending. The play we're putting on it's a relatively short-lived play. It's about 37 days to expiration, and we'll get into that in a minute. And so, we'll kind of see how that goes. But Viper, let's talk about the 1% play, because you weren't here with me last week, but I did have you give homework to hear the episode that we put out there. And what's your take on the 1% play that we laid out last week, or that I laid out?
I think it's great. It's a good, just like you laid it out. So if you're watching this and you haven't seen that episode, go back and do that homework, watch that. And then there's follow-up homework in the episode of going back and watching some earlier episodes about starting trading and stuff like that. But I think it's all well laid out, and certainly a great idea to jump along board. And it's the kind of way that I think is healthy to jump along board, because, like you said, I mean, just when you were talking about Thinkorswim and TD Ameritrade and paper accounts, like, we're not sponsored. We're not, this isn't like, hey, sign up for this class and like do this with us. Like, no, this is just doing the common steps, the safe early initial steps to dip your toes in the water, not take a whole bunch of savings and just go whole hog and into it. So I think it's a great challenge to come alongside and do. And then like you said in the episode, while those deposits are trickling in, fire up the paper account and just start getting familiar with that. Obviously, we've talked about that a lot on those previous episodes. For me personally, the paper account was super useful for understanding the mechanisms of the user interface, specifically for Thinkorswim and specifically around options when you were introducing me to options, because that whole interface was super intimidating. And so, I mean, it was still intimidating when I went to it with real money, but it's nice to poke around the paper account. If enough people are interested, certainly we could do some sort of little fun challenge with the paper accounts, just to, put not really skin in the game, but just a little more of the mentality of like an urgency to do things right and not just throw a bunch of money and see what hits. But for me personally, as people may know, I've been DCAing into those general market indexes, ETFs. And after watching that episode, the first thought was, I was like, you know what? This is perfect opportunity for me to also now start getting back in to my equities account. All things macro related, I'm very happy with where my ETF DCAs are in. I'm up on the year now. So I'm going to leave those going. But I think I would like to take the opportunity to jump into the 1% challenge here right alongside with everybody. So my personal plan is that I am planning to, we basically, like you said, the 1% idea was $10 a week, basically, is what it kind of came out to based on the $52,000 median home income. So I'm going to try to do things on an accelerated time frame, just so that way I have, I don't want to say faster results, but I can start putting my money where my ideas are. And so I'm actually going to do $10 a day. So I want to live by that mantra, or whatever you want to call it, of the dribble in. I'm just going to do it on a slightly faster time frame, just to build up some of those plays a little bit faster. Purely that's based on, where I'm at and where I'm trying to, go. And hopefully we'll see if it works out, but I'm hoping that accelerated time frame just lets me get into some plays that I spot while also still operating in the spirit of the challenge here. So that's my plan. I didn't pick out a play for this week, but I did start my deposits today. So I will plan to have a little update for a play scoped out next week for $70.
Well, let's talk about this week's play. And I'm gonna be honest. I started looking through my screener when it comes to these plays, and I really love option plays, so that's right, my go-to thing. So I started looking at higher volatility things these days, and one of the ones that was more on the bubble was KSS, Kohl's. That just sparked a lot of nostalgia for me, because that was the very first ticker that I did an options trade on in 2019, around this time of year. I think it was more October time. However, that is where I started, so it seemed only appropriate that I kick off the 1% challenge with a KSS play, and that KSS play actually did really kind of make sense. So I was cool with it. So let's talk first about the actual play. Then I'm going to pull up some of the chart to show you, and then from there, we'll jump into the actual Thinkorswim platform, and I'll go ahead and put in that paper trade, and I'll explain the different screens that I'm on as I go through it. Like I said, first up, we're going to take a look at the play, and so I've got it pulled up here. This is the 1% play on Kohl's. And so what we're going to be doing is we're going to be selling a put vertical. And one of the rules of the 1% play was we are never risking more than $100, which means our max loss that we will sustain will not exceed $100. And so I'm going to stick to that. It's going to be tough, I think, because there's not a ton of options verticals that work out that way. Usually 250 is a little bit easier to come by, but there should be plenty for a while. So I'm going to try to stick to it, and I'm not going to violate the rule on the very first trade. So the way this is going to work is I looked at Kohl's and I said, look, Kohl's is a little bit on a bullish tilt. I'll show you the chart. I wouldn't say it's overall bullish, but it's a short term. Looks like it's kind of turning around a bit. And when that is that way, on volatility, elevated volatility, I like to sell premium. And so what we're going to do is we're going to sell a $30 put here, which basically says it's like giving somebody a coupon that says, hey, if Kohl's drops below $30, I'm going to buy it to you for $30. And we're going to do that in 100 share increments. And the first thing in your mind is going to be like, Sprocket, $30 times 100 is $3,000. So you told me this was only going to be $100, and that's where the vertical comes in. So what we're going to end up doing is we're going to start buying protection from a falling Kohl's at the $29 strike. So what we're doing is we're selling the $30 strike and we're buying the $29 strike. And what effectively that limits our risk to basically the time or the gap between $30 and $29. It's only $1 and we're doing 100 shares. So our risk is $100. It'll make a little bit of sense when I pull up one of the charts, but effectively our max gain here is going to be $30 because that's how much this premium vertical is going to sell for. And the most we can lose is going to be $70 because once the stock starts falling below 29, we will have the opportunity to put that to somebody else for $29. So we're only ever out the difference between 30 and 29. If we stay above 30, we keep 100% of our premium. If we go below 29, we basically lose that $100, which is the $1 width there.
And what happens if we're in the middle?
So in the middle, depending on where we are, it'll be some profit or some not profit. So you'll be gray. So the closer you are to 30, the closer you get to profit. And so our break even is going to be, we're going to sell this thing for 30 cents. Effectively is where it should come out. So from $30 to $29.70 is going to be positive. At $29.70, that's going to be our break even. So between $29.70 and $29, that's where we're going to start losing money. And we're basically going to lose $1 for every penny move. Yeah, Viper. So let's try to visualize this just a little bit on this P&L. So let me pull up. This is from Thinkorswim. This is the P&L chart. And what I have here is I have exactly the trade that we're talking about. Selling the $30 call, buying the $29 call, and you get this kind of backward Z looking thing. And this blue line is the profit that we will get if we're above 30, and that's sitting at roughly $31 because it looks like this is selling for 31 cents. And here's the range that you talked about. This is $30 right here. And as we move to the left, you see this slope come down. And this is the profit that we're going to get. And you'll see right at about $29.70, we cross the zero axes. And then from here, we're losing 15, 16, 17. But as soon as we hit $29, we bottom out here at a loss of $69. So this is the max we can lose, the max we can gain. Couple of interesting things that you see on here. This gray area is the expected one standard deviation move before expiration. So this, we didn't talk about this. All right. So unfortunately, at this point in the video, we didn't know it while we were recording, but we lost the audio from my feed. So for the remainder of the video, we actually lost all of my audio. It was unrecoverable. Not sure what happened. So we're going to go ahead and show you a couple of things that we were talking about in that lost audio. And the first thing that we were kind of getting to there with the profit and loss curve was what was the trade setup. So if we take a look here at this screen, I want to talk a little bit about the trade setup that we had going for us. And what you see here is a couple of arrows numbered 1, 2, 3, 4, 5. You see a red bar calling out kind of a critical level that I identified. And this is my assessment of the trade setup. And what we call out here is all these things together give me confidence in the trade, but not really any one of them is a standout. Oh, this is exactly why we make the trade. And so the first case here is, Kohl's has been on a downward slide. The overall trend is definitely downward. So I'm not calling a whole reversal here. I'm just calling out some interesting price action, which makes me think that I can sell some premium here in an elevated volatility to kind of tread water or not go very far deep while that premium kind of burns off and that volatility contracts. So this is a short-term volatility contraction play, which is pretty typical of the type of strategy that I like to deploy myself. And so what I want to call out here for you is on that first arrow, that number 1 arrow that you see there. This number 1 arrow, what we have here is we kind of have an initial low. And so, we had this decline here kind of coming down. We hit this low 1 and we started going the other way. Okay, this is not much, I'm kind of watching it. And then what I see here is I see a retracement to this number 2 arrow. And what this number 2 arrow shows me is we now have a higher low because we hit number 2 and then we bounced off that and kind of went up. So we didn't make a new low. We didn't even come back to that original low where the number 1 arrow is. And so now we come off that number 2 arrow heading to this number 3 arrow, which is where that red line of resistance that I flagged is. And what you see is we kind of bounce off that resistance, not able to overcome it at arrow number 3, okay, proving a little bit more validity to that resistance level. And we kind of fell off that, and then the retracement came all the way down here to number 4. But number 4 is again a higher low. Now, not quite a difference, but we didn't give up that previous arrow of number 2. So again, that is a positive sign when you're looking at the price action to see, are we moving in the right direction? And so again, we then bounce off this and we make another run at that red line of resistance. And this time when we get to that red line of resistance, we kind of end up popping through when we get a gap down, kind of where we teeter on the other side, and then we pop through it again, and that's where arrow number 5 comes in. And this is an interesting arrow because not only did we kind of pop through here, shortly after arrow number 5, we come down and we retest that red line of resistance again. Now, this chart has a couple of extra days from when we originally recorded this, but the thesis still has not been broken. So this is still an enterable trade. But what you got here is you got a retest there of that number 5, and now we have flipped that line to support. So all of these things together kind of show a short-term upward momentum trend. And Viper is going to, I'll go back to the original video because Viper will chime in with his price action here immediately after this segment. And he's going to call out a higher level up here at, I think it was 35.11 or something to that effect. And so really what we're looking at this very short box window here on the trade from the December 1st to the the weekly in January 6th expiration. That gives us our 37 days to expiration. And we're just looking to stay above where this yellow line is. And keep in mind that yellow line is below that critical red line that I've marked. So we have a little bit of margin for error. We might fall through and kind of can come back up. And, this is the trade setup that I was looking at when I drew up this trade.
Yeah. So one thing that I want to point out is just kind of what I'm seeing on the chart. And my read is that I agree with everything as far as the setup and potential and all that. But I do want to color in a little bit more of the risk at hand here. But it's also, we'll call it calculated risk because of the timed nature of what's happening on this play. So if we take a quick look over here, this is kind of the current read that I have on the chart, which is that we do indeed, we have this steady uptrend, which is really good, something we really want to see. And then so what I kind of colored on the chart here is this was just that the yellow box that's kind of faded yellow was just the standard deviation move that Sprocket talked about, the 70% chance that price is in this box. As you can kind of see, this is why that standard deviation makes sense. Like you can kind of see this box, and if we drag it, all the way back to July, you're like, yeah, there's probably a 70% chance that price will stay in that range. But I wanted to call that out as far as just visualizing that. So we have the $30 and the $29 marked here. We have the gray zone in between. Where I see the risk on this play is the fact that, I'm going to call it 35.11 as we talk about the levels that need to be gained on the chart read. And so you can see that we tested it once, we rejected off of it, we made a new low, good. And so now there is an expectation that we should head up to either gain and potentially test that level again. We're certainly in that direction. We've had a little stall here, going back to early November here. We've stalled out and we haven't made any new higher highs, but we are making higher lows. So that's of note. I think it'll be interesting to see how this plays out, because the signs are there from the price action that we did after rejection. We did make a new low and then we started climbing back up. So that's all good and what we want to see. More macro level, we got to get through that 35.11, but then that's where, like I said, timed play. This is an options thing. This isn't like buying the shares and then you got to wait for $40 or something like that. Up to this yellow line, January 6th, that's where you need to not have the price fall below 29.70 to still be in profit. And so as far as that goes, it looks very interesting and worth the calculated risk, I think.
All right, so the other part of this video was to put on the actual trade in the paper trading account to show you what the mechanics of entering the order are, what types of things you might see on the interface. And this is example on Thinkorswim interface, which is the TD Ameritrade broker that I use. You'll want to use your broker, your paper trading account, so you can familiarize yourself with that user interface. But let's go ahead and take a look here. I've punched in the ticker KSS here. This pulls up the coals. And then I have gone to the option chain. And when you pull up the option chain, this is going to show a large listing of various dates. And what each of these dates are the expiration of that particular option. And so, like I said, I like to go for the 35 to 45 days for expiration. And in the video, we went with January 6 weekly. Now, that's not normally the type of option that I like to trade. I like to go to the monthly options, which would be the 20th of January option. The problem here is at the time of the recording, that was greater than the 45 days and actually still is today. The second and larger problem is the width of these strikes. So when you open up the chain, you can find these numbers called strikes here in the center, and they're calling out, what is the strike? So 30, 27.50, 25, 22.50. And you'll see that these are all $2.50 apart, which basically mean that these are going to be $250 plays if you split these strikes. That is in excess of our $100 budget. So the monthly options are no good at this time to trade. And so we went with these January 6 options. And like I said, in the original video, I had mentioned I don't like these as much because they're not quite as liquid. In this case, they're okay, but you can tell that this liquidity is definitely not as high as the monthly. And the way that I tell liquidity is how close is the bid and the ask. So here you got 20 cents difference between your $30 strike, your bid and the ask, 142, 163. Here we got almost another 20 cents, 105 to 124. And just to take a look here at the monthlies for those closer strikes, is it aftermarket, but these are a little bit closer. Not a ton closer, but a little bit closer. And when the markets are open, these will tighten up a little bit. They'll even tighten up a little bit on the weeklies. So like I said, they're not terrible. They're not ideal, but we are a little bit limited on the capital here. And so, this January 26th is where we want to go. Or January 6th, I'm sorry. And this next number here, this 33, this is just a shortcut so you can, don't have to do so much math in your head. This is the days to expiration. So right now when I'm recording this is 33 days to expiration. When we did the original episode, it was 37. This is the strike. These numbers over here to the far right, these are basically calling out what is the volatility on that exact expiration week. So you can see the closer you are, you got a higher volatility here for this upcoming week. The volatility kind of falls off, but then ramps back up. So anyway, January 6th is the ones that we are looking at. And so we're going to open those up, and we're going to come down for the strikes that we're looking for. And we were going for the $30 put and the $29 put. So this is a little bit higher delta now because we have fallen off a little bit from that original trade. I'm going to stick with it here just to show you how to enter it. But if I was kind of redoing this trade at this juncture, I'm probably going to fall back to that 30 delta, and I'd probably go between a 29 and 28. But to stick with the original video, we were looking at a 30. And so what you're going to do is you're going to go ahead to this bid price on the puts. The puts are on the right. Everything on the left are the calls. So $30 strike here, I will say sell. You will see it will pop up down here. Now this is only one leg of the option trade because we also want to get another leg of protection. And so we want to execute it on the same trade. You could technically do these separately, but your broker will probably see that as a naked trade, not a defined risk. And depending on your level of approval, they might not let you take that trade. So we want to put these two legs together in one order. And the way that we do that is when we come back up here to the strikes, we're going to hold down the control key. And then that control key is going to let us add a different leg to the same order. And so I'm going to click on this 29 strike and say we want to buy the $29 strike. And you can see right there, it's going to smash these two things together. This name over here switched from single to vertical because now we have a vertical play defined, and both of these are in the same order. And if we take a look at the risk profile here, you'll get a chart similar to what we were pulling up earlier, which is, your max profit on this trade is $38. Your max loss is $62. Again, this has shifted a little bit since the original recording, but this is how we would enter this trade. So now we've got both of those. We would come in here and we would say confirm and send this order. Now, this doesn't actually send the order right away. And this is going to pull up a dialog box. And what that dialog box is going to show you is kind of your trade confirmation screen. So it's going to reiterate almost like, hey, this is everything that you entered. Are you sure you wish to proceed? This is where you can kind of catch mistakes in case you accidentally had an order quantity too high. Maybe you weren't really quite sure and you tagged the wrong thing. You're going to see your max profit here is $38. Max loss is $62. It'll give you your buying power effect of $63.30. This means it's going to consume $63.30 of buying power. That is the most that this trade will consume of buying power. It will show you your resulting buying power left for options or for the stock. And then at this point, if everything still looks good, then you can push send. And it's at that moment that that order will go to the broker on their paper trading account. If the market is open, it will go ahead and just automatically fill at whatever price that you have set. It will just assume that that's there. It doesn't really simulate the fills. On your brokerage account, if this was live, you would likely get a fill if you were set at the mid price. But because the bid and ask are kind of far apart, you might have to wait a bit before you get a fill. But I'm not going to go ahead and put this in. That is effectively how you would enter this order. And I'm not going to go ahead and push send because I don't want to put this on. The market's closed, so the paper trading account won't actually fill. Anyway, that is exactly what it would look like to go through your paper trading account. Hopefully you can do that on your own. Enter the account, get your auto deposit set up. I apologize for the technical difficulty in this week's video. We also lost our wrap-up session and our summary of things. I'm not going to go ahead and try to recreate that. So good luck out there this week. And remember, think outside the block.